This video is designed to help Year 12 accounting students know and understand how to report for inventory. Now, there are many different parts to reporting for inventory. This is an introduction that is designed to go along with information from Chapter 8 of the Cambridge textbook for VCE Accounting Units 3 and 4. So what we have here is we have an income statement extract taken from the Cambridge text. This shows us the general layout of an income statement. Once again, only an extract because it finishes at adjusted gross profit. This section of the income statement doesn't show other revenues or expenses or the net profit. And this section here is sometimes referred to as the trading statement. It shows the impact of inventory on profit. So you can see that all of these different parts of this extract up to adjusted gross profit are showing all of the impacts of inventory, sales of inventory, sales returns of inventory, cost of sales for inventory, different costs associated to get inventory ready for sale, and also inventory loss or gain. So one of the skills that you may be asked to do is to construct an income statement from a trial balance. To construct an income statement, when you're getting this information, first thing you need to do is you need to be able to identify the revenues and expenses. Second thing is you need to sort them into the subsections of the income statement. So I've put here that we have revenue, cost of goods sold, inventory loss or gain, other revenue, other expenses, and then you can construct. So for step 1, what I would usually do is then code my trial balance. So I can see here that I've got some account payable and receivable. So I would simply code these as liabilities or assets. Bank has a debit balance, so asset. Capital, so owner's equity. Cost of sales is an expense, so I'm going to put a little tick next to that one to tell me I have to use it. Customs duty is going to fall under cost of goods sold, so I might put expense, or I might even write cost of goods sold here. Drawings, GST, interest, inventory, mortgage, premises, sales returns as a negative revenue, shelving, and wages. So I can see from my trial balance I've got 6 items. Don't forget to also look at your additional information. So additional information, point number 1, this is going to be about my inventory loss or gain. So I can see that the count showed 19,000 for inventory, whereas my balance showed 19,500. So this is going to be an inventory loss, and that needs to be included. The principal of the mortgage is repayable, so this is just showing what's going to happen with the loan. So that's step 1. I then subcategorize these. So I'm going to put in things like revenue, negative revenue, same as what I've done before. This is going to be other expense. This one goes under cost of goods sold. This one goes under cost of goods sold. And this one here, I normally put this AGP for adjusted gross profit. I now have all the information I need to be able to then construct my income statement from this annotated trial balance. So some things that are important to know about reporting for inventory. I put this in the form of a lot of questions I get from my students. Do I need to report every line of inventory separately? No. Reports are designed to act as a summary. If we need further detail, we can then go back to our records, so go a step back in the accounting process. So if I want to know exactly what items were sold on the 5th of October, I would then go into my inventory cards, my general journal, or my general ledger accounts. The characteristic of relevance supports this, the idea that reports need to contain enough information that's useful for decision making, and at this stage the reports, a total for the inventory account would be sufficient here. Do I need to report sales returns separate from sales? Yes, it is a separate account in the general ledger, therefore it should be recorded and reported separately. They're also important to know because sales returns are a really good indicator of problems or issues that you might be having with your inventory. So an example would be if you've got a higher level of sales returns. This might indicate that people are unhappy with your product, or it might be of poor quality and things like that. Question 3. Are cost of sales and cost of goods sold the same thing? No. Cost of goods sold is the term that we use for all costs to get inventory into a condition and location ready for sale. So that might include other items, and you'll see these more in Chapter 9, but things like maybe a customs duty, some kind of freight into the business, some kind of modification. So cost of sales is only the cost price of the inventory, and when we explore that a little bit later, this will make a bit more sense. What is the difference between gross profit and adjusted gross profit? So gross profit is the amount of sales less your sales returns, less cost of goods sold. So this is thinking about the profit that comes from inventory. The adjusted gross profit also incorporates inventory loss or gain. So that's the only difference between the two, and that's why we separate. Once again, so you can see your loss or gain amounts and make decisions based on that. So if you notice that there's a high level of inventory loss, you might want to investigate if it's theft, damage, and change your inventory management practices. So what we've been looking at through all of these videos is the perpetual inventory system. The perpetual inventory system is where you record inventory transactions in inventory cards, and the idea of perpetual is that you're constantly recording what's occurring. So each time there's a transaction, it gets recorded in our inventory card. We also do things like keep a running balance. The part of this system is also that there's a physical inventory count at the end of the period, and we use the physical inventory count to check the balances in our inventory cards, and we make adjustments if there is any loss or gain detected. So what's important here is to know what are the benefits and costs of this perpetual inventory system. So the benefits and costs are that there's timely information for reordering. So we know when our balances of inventory are getting low, and we can reorder from our suppliers. This helps uphold timeliness. We also have inventory losses and gains being detected, which helps us to have more accurate records, so verifiability and faithful representation can be maintained. And we can also detect which lines of inventory are fast or slow moving, so which ones are selling really well and which ones maybe not so much. And that allows us to adjust what we call our stock mix. So in other words, stock more of the fast moving items, stock less of the slow moving items, think about where we place them in the business to try and boost sales and profit. The disadvantages or costs of the perpetual inventory system are that there's a high cost of staffing and use of technology to record and maintain this system. And the reason why is because we are continuously recording every transaction. But as you can see, there are far more wide-reaching benefits than there are costs of this system, which is why we use this as our major system of accounting for inventory in the VCE accounting course.